Your rent went up, your groceries went up, stocks, crypto, houses. And somehow your paycheck is the only thing that didn't get the memo. Everyone's got a villain for this. The AI bubble, the debt, the Fed. All wrong. Not because they don't matter, but because they're not the disease. They're symptoms. One invisible thing pulled all of them up at the exact same time. One string, tied to everything you own. I'll show you exactly what that string is. And once you see it, you can't unsee it, because you're already holding it. Your portfolio, your rent, your retirement. You're inside it. To understand the string, we go back to the moment it got tied. 2008. The financial system is melting down. Banks are collapsing. And everyone is terrified. To stop a full-blown depression, the Federal Reserve does two things it had never done at this scale. One, it slashes interest rates to almost zero. Borrowing money suddenly costs almost nothing. Two, it creates brand new money to buy up bonds. This is called quantitative easing. Fresh money, conjured out of nothing. And a quiet promise settles in. If things ever get bad again, the central bank will step in and rescue everyone. Meet Ryan. He owns some stocks. And thanks to all this cheap money, his portfolio just keeps climbing. Ryan's thrilled. He doesn't ask why it's going up. Nobody does. When you're making money, you don't question where it comes from. Now here's what everyone assumed, that this was emergency medicine, temporary, that once the crisis passed, the Fed would shut it all down. It never got shut down. Rates stayed on the floor for years, and the Fed's balance sheet, the size of the whole operation, never went back to normal. The emergency became the new normal. Then, 2020 hits, a global pandemic, and the Fed doesn't invent anything new. It just does the same thing, 10 times bigger. To picture the scale, imagine the money machine was a bathtub. In a few months, it went from nearly full to overflowing across the whole floor. Trillions added almost overnight. And this wasn't just America. England, Europe, Japan, the biggest central banks on Earth all did the exact same thing, at the same time. And that's the real point. The price of money, everywhere on the planet, and got crushed to the floor at the exact same moment. Remember the string from the start? That was it. Cheap money, everywhere, pulling on everything. But that opens a strange question. How can one single thing inflate things as different as a house, a stock, and a Bitcoin? The answer is three hidden channels. So how does cheap money lift a house, a stock, and a Bitcoin all at once? Three channels. Channel 1. The value of almost anything is really just its future income, pulled back to today. That's how markets price everything. And the tool used to pull it back is the interest rate. High rate, the future is worth little today. Near zero rate, the future suddenly becomes worth a fortune. This is why growth stocks, real estate, tech, anything paying off far in the future, all shot up together. Ryan thinks he's a genius. He isn't. Channel 2. When central banks buy up all the safe bonds, they remove the safe place to park money. So the safe option pays almost nothing. So everyone, pension funds, insurers, even careful little Ryan, gets shoved out of safety and into risk just to earn anything at all. That's why money flooded into stocks, property, private funds, and eventually crypto. Not greed, just no other choice. Channel 3 is the dangerous one, because cheap money doesn't just lift prices, it makes borrowing against those prices easy. Here's where it becomes a machine that feeds itself. Assets go up. Higher assets are better collateral. Better collateral means you borrow more. That money buys more assets, which pushes prices up again. Round and round. Ryan feels rich now. His house is worth more, so the bank lets him borrow against it. He buys more, but look closely. This whole tower isn't built on cash anymore. It's built on debt, stacked on cheap money. So here's the full picture. One cause, cheap money. Three channels lifting everything at once. A tower of debt holding it all up. There's just one problem. This entire system depends on one thing, money staying cheap forever. And in 2022, that assumption broke. Because there was one enemy this whole system couldn't survive. Not a crash, not a war, inflation. In 2022, prices exploded, and central banks faced a brutal choice. Keep rescuing the markets, or save the currency itself. They chose the currency. The superhero that spent 15 years catching everyone took off the cape and unplugged the machine. Rates rocketed from 0 to over 5%, the fastest climb in decades. And the money flood started flowing backwards. And remember that beautiful self-feeding loop? It works in reverse too. Assets fall, collateral shrinks, banks lend less, forced sellers appear. Selling pushes prices lower. The machine eats itself. Now, here's what actually happened. And it's not what you think. The bubble didn't explode everywhere at once. It deflated floor by floor, starting with whatever depended most on free money. Unprofitable tech, SPACs, the 2022 crypto complex, venture capital, then commercial real estate. And right now, private credit funds are freezing withdrawals. Ares capped redemptions. Morgan Stanley limited exits. The purge isn't history, it's happening. Which brings us to the strangest part of this entire story. Because while all of that was breaking, the stock market hit all-time highs. Ryan looks at his portfolio. It's green. All-time highs everywhere. So, the danger's over, right? The bubble popped. We survived? That's exactly the wrong conclusion. And history explains why. To see how this movie ends, we don't need a prediction. We need a history book. Tokyo, 1989. Late 80s, Japan had everything we just described. Years of cheap money, booming stocks, booming real estate, all at the same time. At the peak, the land under Tokyo's Imperial Palace was worth more than all of California. And everyone had an explanation for why it made sense. Japan was the future. This time was different. Then the Bank of Japan raised rates. Sound familiar? And here's the part that answers Ryan's question. There was no single day of collapse. No dramatic explosion. Just air leaking out. For years. Then decades. The Japanese stock market took 34 years to reclaim its 1989 peak. Now, Ryan's got an objection. But AI is real. These companies are incredible. And you know what? He's right. So let me tell you about 50 companies from 1972. Coca-Cola, McDonald's, Disney, real products, real profits, total dominance. Investors call them one-decision stocks. You buy, you never sell. Guaranteed. Then rates turned. Those excellent companies fell 60, 70, 90%. Because here's the lesson history keeps teaching. A technology can be revolutionary and still be wildly overpaid. Both at the same time. So now look at today. Years of cheap money. Every asset up at once. A handful of giants carrying the whole market. And everywhere, the same four words. Say them with me. This time it's different, which leaves one final question, the only one that actually matters. What does someone like Ryan do about it? So what does Ryan do? Well, first, the honest part. Nobody knows when. Anyone selling you a date is selling you a story. But here's what Ryan can know. What he actually owns. His portfolio first. If money stays expensive, valuations compress. Remember Channel 1? Even great companies can shrink in price. His dream house next. High long-term rates mean expensive mortgages. His buying power just isn't coming back yet. But here's the one Ryan never thinks about. His retirement account. Every month, his index funds automatically buy the market, which means, automatically, he buys the bubble at peak prices, without ever choosing to. Remember the beginning? You're inside it, literally. And that's the real point of understanding all this. Not predicting the pop, knowing what you own and what it's actually sensitive to. Because this was never really about AI, or debt, or the Fed alone. It was about the global price of money, and what happens when it gets crushed. And there's a reason financial media doesn't cover it this way. Slow air leaks aren't clickable. That's exactly why this channel exists. To cover the mechanisms that actually move your money, not the headlines that move clicks. So if you'd rather understand the machine than react to the noise, subscribe. You're in the right place. Because there's one thread we left hanging today. We said debt was the accelerant, not the cause. Next time, we pull that thread. The debt spiral. Because the most dangerous bubble isn't the one that pops. It's the one you're standing inside, without knowing it.